Our speaker this morning is Nicholas Atkeson, and he is a founding partner of Delta Investing. They're up in San Francisco, and he'll probably mention a weekly Friday broadcast they put out, and that's a really good read. I get a lot of things in my emails. The Delta email is one I always read every week. Plus, they have a great cartoon too, and so there's real incentive to read. I don't know how many of you like financial jokes. Anyway, it's like the guy who is in a. Can you hear me? Okay. Like the guy who goes to a cocktail party and is bragging about the fact that he has $500,000 in the market. And a lady asked him, well, how did you manage to do that? He said, well, 3 months ago, I inherited $1 million. So anyway, the title of the presentation is 2020 Outlook at 2020 and How the Stock Market Might React. Nicholas is he's actually introduced himself to some degree right now with his comments. I've always found his programs and presentations interesting. I think Delta's talked to us at least 3 times, if I remember right. And he is the founder and partner for Delta Investment Management, registered investment advisor for a firm in San Francisco. Prior to Delta Investing, he was a partner and manager of the Delta Forest Capital LLC in San Francisco. He's, let's see, he's co-authored the book Winning by Not Losing. That's a really important concept if you think about it. Disciplined approach to building and protecting your wealth in the stock market by managing your risk. I do a number of different, one of my real interests in life is teaching people about how to invest, and AAII fits that perfectly. I've also done some side classes dealing with risk management and self-reliance and just the ability to maintain and build wealth. And many people do not understand how to do that. And I don't know how many of you are aware of this, but more than half of the lottery winners, after five years after they got their $20 million or whatever, more than half of them are worse off 5 years after they win that than they were before. Think about that. And that's the issue of managing your own wealth. Anyway, let's give a warm welcome to our speaker. I'm looking forward to his presentation, and wait for the mic.
Okay, well, you got a sense that, we come from an institutional trading background, and so our outlook is usually 2 minutes. No, I'm kidding. Now, do you want the secret to getting rich? Might as well just start with that. The secret to getting rich is invest early and live a long time. All right, now that we haven't done any of those things, let's get to what we have to do today. Okay, so this is Delta Investment Management. This is this is a group in San Francisco, and the interesting parts of this is that Mike Kress has been managing money, I'd say tactically, meaning reducing exposure in downturns and increasing exposure in bullish times since 1971. Andrew and I, there have only been 3 down 50% markets since World War II, 73, 74, 2001, and 2008. And you always wonder, if somebody says, well, I'll protect you from the next one. Did they do it in the prior one? And so the good news is we have a team that's done it, and one of us has done it in all 3. And then Kyler is a guy who newly joined us. He's a stock picker. His fund was up 50%. He's a best idea stock picker, so he creates a fund of about 10 stocks. Generally in investing, when it comes to stock buying, my first thought is don't outsmart yourself. At least own the index, right? It's cheap and easy. If you would have been happy with the S&P 500 returns over the last 10 years, or you would have 20 years or whatever the period is, and you don't own the S&P, the question is why not? If that return is okay, it's easy to buy it, it's cheap. But if it's going to come to stock picking, which I think is very hard, and it's truly hard to create outperformance over time, you don't want a picker to pick his 100 best ideas, that's like telling you I'm going to introduce you to my 100 best friends. You don't have 100 best friends. You don't have 100 best ideas. You want best ideas. So even 10 best ideas is sort of kind of a stretch, right? But when you're managing a portfolio, you can't go much below 10 because then you get kind of unpredictable volatility. So in 2013, McGraw-Hill asked us to write a book called Win by Not Losing. We wrote that book. It's sold out on Amazon, actually. We write a newsletter that comes out on Fridays, and the original purpose of the newsletter is on the back, on the end of it, it has the Delta Market Sentiment Indicator. That's an intermediate term trading indicator. Barron's publishes it. It tells you over the next 3 to 6 months whether we're bullish or bearish. It's kind of a momentum price-based indicator. We have a couple strategies that are actually tied to it and managed by it. But in your handouts today, there's a sheet like this. The first, 500 words of the newsletter, and it's usually about 400 or 500. It's fairly short. We just talk about what we're thinking about in the market. We point out something. And then we have the indicator in the back. If you want this newsletter, we just send it to you for free. Make sure you give me the response sheet with your email address. If you don't put your phone number on the response sheet and I can't read the email address, then there's no way I can call to find out what your email address is. If you sign up for this thing and you don't get it next Friday, then something went wrong. That's Barron's. They published the Delta Market Sentiment Indicator in Barron's. Okay, so let's talk about 2020. I'll probably sound kind of mealy-mouthed, but I'll give you, at least what I'm thinking about. Okay, so performance and style. 2019 was all about growth stocks. The large cap growth for the year was up 36.4%. Actually, small growth outperformed in the fourth quarter, 11.4%. But generally, you wanted to be in growth stocks. There's this thought that growth has been outperforming now for 10 years. Maybe we should flip back to value being the source of outperformance. I don't think that's going to happen. I'll show you why not later in the presentation. So this is a chart that we show almost always, and what it's showing is from 1980 till today. I'm just wondering if there's a pointer associated with this. Anyway, from 1980 to today, the vertical gray bars are the calendar year returns of the S&P 500. The red numbers underneath with a red dot, that's the largest intra-year drawdown of the S&P. So last year we were up 29%, but we had a 7% drawdown at one point. In 2018, the year was pretty bad. Remember, this is calendar year S&P 500 returns without dividends, so it shows negative 6%. That's the worst non-recessionary year since 1980, and we had a 20% drawdown. That all happened in the fourth quarter. Anyway, the areas with red circles are recessions. The point of this chart is to say, if you're not in a recessionary period, you want to own the market. The times when you don't want to own it is around recessions. That's when you get big drawdowns and big negative calendar year returns, and it takes forever to get your money back, like 5 years. So the question about 2020 is, are we going to go into recession? If you're not going to go into recession, after that it doesn't make too much difference. Just probably own the market because you'll get a reasonable result on a calendar year basis. Okay, so this is just a chart. This is the same information. It's just presented in chart form, and it's showing on the left-hand column, drawdown percent, 5 to 10%, 10 to 20%, 20 to 30. It's showing the number of occurrences since 1950, and then days to recovery, days of decline. The whole point is until you get down below 40% drawdowns, the days of recovery are actually fairly short. So, like, for example, the 20% decline we had in the fourth quarter of 2018 was basically fully recovered in the first quarter of 2019. A lot of people made the mistake of trying to tactically trade that. They did it badly. In other words, they may have gotten out, but they never got back in. That's a common mistake. Okay, let me do one thing real quick. Okay. So I sent these slides to Bill Jump a little over a week ago. A lot changed in a week. Okay. I have to remind myself what was happening a week ago. Okay, this is a chart of the S&P 500 and the multiple. And the multiple, the forward 12-month PE of the S&P 500 right now is 18.2 times. It's normally around 16. So it's a bit elevated. So it's fair to say the market seems a little overbought and a little bit expensive today. It'd be reasonable to say you'd be less bullish today over the next 12 months than you would have been a year ago at this time. Now let's put it in context. People say, well, all of the market activity has been multiple expansion. Not really. If you start at January 2018, we actually had tremendous earnings growth in 2018, but the market was down. And then in 2019, we had no earnings growth and the market was up. If you combine the two, what the gray area underneath the orange line is the S&P 500 return. The green area is earnings, and you see a blue sliver for dividends, and then this gray area is sort of what's happening to the multiple. So we had tremendous multiple contraction in 2018, and we had multiple expansion in 2019, and the net effect is that little gray area on the top is the amount of multiple expansion sort of above sort of where we would have started. In other words, that's the move from 16.2 or 16.2% to 18.2. So we have had a bit of multiple expansion, but it doesn't explain the entire thing. Earnings had a lot to do with it. Investors don't like stocks today. It's not like we have irrational exuberance. There's a lot of concern about owning stocks, and the way we look at that is just by money flows into stocks. Cumulative flows into stocks, mutual funds, ETFs, negative $225 billion over the last 2 years. Flows into bonds, $465 billion. Bond spreads have gotten very tight relative to historic levels. Bonds are kind of a risky place to be. If spreads start to widen out, that will be a very bad thing for bonds. Okay, so our history as a firm is we've been kind of quantitatively based. You need some sort of structure to think about the market. I think this formula here, which is just the present value formula, is extremely useful because essentially everything that goes on in the world can be put into this formula and give you some sense as to where the market can go. If the market is in a place that the math doesn't agree with, there's probably something wrong, right? And things could change. And if the math lines up with sort of what it is you're thinking about, then you've got a reasonable justification for thinking what you're thinking. But I do think you have to back what you think up with some kind of structure. And here's the structure we often use. So basically, the value of stocks today is equal to the sum of their future earnings divided by the risk-free rate plus the risk premium. The simple idea is if you're going to buy a risky asset, the returns of this risky asset have to give you something greater than a risk-free rate of return. So the important variables here are future earnings, but I would say the most important variable here is the risk premium. It's the thing that moves around the most. And it moves very fast. It can move overnight, right? It can move on a Trump tweet. So when you get a Trump tweet that's disturbing, you can say the risk premium is going to go up, stock values are going to go down. When you get a Trump tweet that's pleasant, you get the reverse. Earnings don't move around that much. We got a question in the back.
For the risk-free rate, what are you actually using? 10-year or what?
Okay, so I'm going to go through each variable here because that's exactly how we're going to derive the 2020 outlook. We're just going to plug the numbers in. And then you can say you agree with those numbers or not, but at least we have a structure. So it's, it's not just my opinion. All right, so let's start plugging the numbers in. So let's look at earnings. So these are the calendar year 2019 earnings and calendar year 2020. The current, and these are, rough. When I say rough, they could be off by pennies. The calendar year 2019 earning, which we have yet to know because the fourth quarter is about to be reported, is 162. Calendar year 2020 is 178. The point of this chart is to say that a year ago, way over on this side, when analysts were predicting earnings, the earnings projections were way higher. So the problem is, when we ask the question, what are earnings, whatever they are today, they seem that they have a downward trajectory. Like if we go out 6 months, if this trend continues, whatever the earnings projection is today, it looks like it might be lower. I say that, and so we watch the earnings projections very carefully. Every week you can see what the consensus analyst earnings estimates are. It looks like in the last couple weeks they've stopped going down and they've started to go up. That is essential to the 2020 outlook. If earnings keep getting revised downward, it's not going to be very good. We just know that from the math. So we need to have earnings stabilize, at least stabilize and go up. So now here's the current situation we're in. These are earnings dating back to 2009 for the S&P 500. It's interesting to note that from 2014 to 2016, we had an earnings recession. You can have corporate earnings go down quarter after quarter after quarter, in that case 6 quarters in a row, and not go into a GDP recession. How did that happen in 2014? Well, what happened was oil prices went from like $110 to $35. You had a depression in the oil industry because there was so slow growth in the other 9 sectors of the S&P. The negative earnings revisions in just the oil sector caused the aggregated number to be negative growth. But the other 9 sectors were actually growing, just not enough to offset the very large loss in the oil sector. So when you added it all up, you had negative growth, but we were not in a recession. 2018, 2019, we had no earnings growth. The market, as we know, went up about 30% in 2019. It seems to be anticipating something good. The earnings in 2020 now are, about 178, and then 2021, 196. So you get 10% earnings growth and 11% earnings growth. So right now, as we stand today, it looks like earnings projections have stabilized. The current projections are for 10 and 11% growth over the next 2 years. What is okay, so that takes care of the numerator earnings. What is the risk-free rate? We use a 1-month treasury rate. So we think lending to the U.S. government for 1 month is pretty riskless. Right now, it's about 1.5%. We've heard from the Fed that unless something significant changes, they like where they are with the Fed funds rate. The Fed funds rate is not the 1-month treasury rate, but the 1-month treasury rate is impacted by the Fed funds rate. So to get a sense of what's going to happen to the 1-month treasury rate, we do look at what the Fed is doing with the Fed funds rate, and basically the assumption is nothing. So for the year 2020, we think the risk-free rate is going to stay about 1.5%. This is a chart of the Fed funds rate, and it goes back to 99, and you can see the red comes down, it goes up, it goes down. It goes to 0 essentially, from the credit crisis through end of 2014. And then we come out to this place where we have blue dots and brown triangles and blue triangles. The blue stuff is what the Fed is projecting as their rate assumptions. The brown is what the market says the rate assumptions are. The Fed has been persistently wrong for 2 years. They've been too high. They've been assuming inflation is higher than what it will be, what it's been. And so they're always too high. But you can see that the market, which again has been right, is showing no real increase in the Fed funds rate for 2 more years at least. So that helps bolster this idea that the risk-free rate is 1.5. I'm just going to give you the idea of the importance of the risk-free rate. In October of 2018, the Fed says that they were going to raise rates at least 2 more times in 2019. The market didn't like that. Earnings didn't look so good. Economy looked like it was slowing, and now the risk-free rate went up. So if you stuck in you put the new risk-free rate in the math, it said the market's going a lot lower, and we went lower. Then in December, they said, oh, we're not going to raise the rate. We may actually cut it. Market ripped right back up. That was all. If you just changed the risk-free rate in that formula, you would have come out with the numbers. So it mattered. That to me was essentially the story of the fourth quarter of 2018 and the first quarter of 2019. It was figuring out what is the risk-free rate. Okay, more on interest rates, which is, where interest rates are in part is set by inflation. Inflation has been persistently below the Fed target of 2%. It's still, they're using the core PCE deflator for their measure of where they are relative to their benchmark, and it's 1.6%. They're trying to get it to 2. It does appear that we have some wage growth. The labor market's quite tight, and if that continues, that could be a source of inflation, both from a cost of doing business because you have to employ people, and also people just have more money, so they spend more. So you have both sides, demand and supply side inflation. Okay, now let's talk about the risk premium. Question in the back? Hold on, wait for the mic, I guess.
On your previous slide with the market expectations of that rate, so the flat projection that the market's projecting, is that somebody's forecast, or is that futures
market on
futures
it.
market? Okay,
Yeah.
Got it. Thanks.
No forecast. Yeah. Anybody who makes a forecast is nuts if it's more than about a second forward, right? Okay. So risk-free rate 1.5. Earnings, that prior chart I showed you, look okay. We've seen that the revisions, so we got earnings, we got risk-free rate. Now let's talk about the risk premium. This is a hard one. Risk premium. Okay, one place to look at risk premium, and I think this is it's really easy. You can do it anytime, any day or night, and it can be very, very helpful, and I'll give you a great example of when it was really helpful. This is the differential between the junk lending rates and treasury rates. So lenders, when they're worried about the economy, they're afraid they're not going to get paid back, they raise their lending rates to make the borrower pay more to compensate for that risk. And so that's a spread between that junk lending rate and the treasury rate. When we got the guy with the drone missile strike, the spread was 3.61. 3 days later, it was lower. It was like 3.5, which is fascinating. The bond market is 3 times the size of the equity market, and the bond market said that the world had become a less risky place in the wake of that drone strike. Okay, that's interesting because that kind of confirmed what the stock market was doing, which was essentially nothing. The market didn't react. You could have said in an overbought highly valued market with an extended PE, you create uncertainty like that, the risk premium would have popped and we would have seen it. I mean, if you'd asked me before that event, what were the chances the market would go down on that news in this environment, I would have thought absolutely the case. But it didn't. So then you waited, well, okay, well, what's the next shoe to drop? What's the next? But the bond market, this, and I don't have it because I sent these slides a week ago, but this number came down. So you could have gone on your computer and typed in high yield spread, literally, those words, and come up with the St. Louis Fed and seen this chart. And you would know at home, wait a second, the market is saying risk is down. The risk premium is going lower. That's positive for stocks. One time when this really was helpful was in December of 2018, when the market in the third week of December was really going down. I mean, hundreds of points a day in the Dow. The yield spread all of a sudden got tight. You see this spike up right there? Okay, that was December 2018. While the market was at a low, you see how it comes knifing right back down? So something happened in the bond market where they decided risk was diminishing. That was a great buy signal. On top of that, just to throw it in there, the Delta Market Sentiment Indicator was below 10. That's an extraordinarily good buy signal. So you had that. You had the risk premium collapsing. You had a very oversold condition. That was a good buy time. One way to use this chart is that as long as the high yield spread is below 5%, things are kind of fine. Once it goes above 5% and rising, the stock market is going to have a very tough time. The risk premium is starting to rise in a meaningful way, and it's going to put downward pressure on stock prices. This shows that 2015 period. You know, we were down 14% or so, and it was, you know, August, whatever. We were rebounded in November, and then first 5 weeks of 2016, we went right back down. There it is. But you could watch that, and when you see it reversing course or breaking down below 5%, it's a good buy indicator. Okay. So you can calculate what the risk premium is. If you know what the stock market price is, and if you know what the risk-free rate is, and you know what the earnings are, you just do the algebra to put in the risk-free rate. I mean, the discount, the risk premium. Okay. This is the risk premium of the market by year, 2000 through 2020. In 2000 and 2001, we probably all could say it felt exuberant, right? But what did that mean from a risk premium standpoint? It meant that people weren't getting paid to take on any risk because they were so darn confident that growth was going to be endless and there were no risks in the world that they didn't get paid to take risk. The risk premium was actually negative. They were getting paid less to buy risk assets than they would have been if they just bought treasuries. By the way, treasuries way outperformed for the next couple of years. Same with 2007. The risk premium got nearly to 0.4. No one was getting paid to take risk in 2007. And then it exploded. Again, treasuries really outperformed. Today, the risk premium is about 3.5, right? So you're getting paid something to take risk. Okay. And by the way, 3.7 is sort of the average for the last 20 years. So at least, you know, from the math side, you're not being irrational if you're buying stocks today. You're getting paid to buy stocks. You should only buy them. You should only buy a risk asset if you're getting paid to take on the risk of owning the asset. Okay. But 2020 is an election year. Election years have elevated risk premiums often just because of uncertainty, whatever. So I arbitrarily plugged the risk premium at 4 for the year. So if I put those numbers in, the 20, so you go out a year and you say, what's the forward 12-month earnings number? It's 196.84. What's the risk premium? 4. Risk-free rate 1.5. That equals a stock market forecast of 3,579 on the S&P 500. That's it. Now, okay. This can only hold up if the earnings is accurate. I mean, you can't be comfortable about anything, but we're sort of comfortable that the risk-free rate's going to be fine. The risk premium can do a lot of things, but we just went through an episode with Iran that didn't do anything to the risk premium. So I think by putting it at 4, we're being kind of cautious. If you go home and just change that to, you do sensitivity analysis and change the risk premium down to 3.5 or 3.7, it's going to boost your S&P number quite a bit. So that's the forecast. The questions are, what's wrong with it? Well, again, what are your choices? Risk premium, earnings? There's not a lot of moving parts. Okay, so now let's talk about what could be wrong with it. One, we may be going into a recession. Why do I say that? I say that because we look at the leading economic index, which is a measure of 10 macroeconomic factors of the economy, and we look at the percent change month over month of this index. And from 2016 till September 2018, every single month had a positive increase in the leading economic index. Since October of 2018, you've had down and up, down and up. What does down and up mean? Well, when the 6-month moving average of the leading economic index turns negative, the chances of a recession basically are, we've always had a recession. It's always occurred that we get a recession. Almost no false positives. Currently, the 6-month moving average of this thing is negative. But they release the data and then they revise back for 2 months. So we actually really don't know if it's negative for another 2 months. If it remains unrevised, it's negative. If they revise it higher, which is highly possible, it may not be negative. So all I can say is, at this time, it's fuzzy. You know, this is a mealy market. The market, my favorite institutional analysis, if anything, is the stock could go up or it may go down. But, you know, right now, I showed you the forecast, 35, whatever, 3,500 on the S&P. What's wrong with the forecast? Well, potentially we might be going into recession. Then you can throw everything out, right? Because then risk premium rises, earnings drop, the whole thing falls apart. But we don't know that yet. This is one reason to get the newsletter. We will let you know when we know. The good thing is this is a very long-term leading indicator. So we have time to see how it plays out. It's not like we're going to go into recession tomorrow. It's just sort of saying we might go into recession 8 months from now or something like that. It's not immediate. Okay, now let's talk about things that are interesting and going on that the world's maybe a little different. So this is a slide trying to show sort of investment spending by companies, non-residential investment spending, and this is without processing equipment and intellectual property products, sort of non-tech stuff. And you can see it has this sort of a, you know, it goes up, it goes down, it goes up, but since like 2015 or something, this non-tech investment spending by companies has not really grown much. And it's one reason why people say the economy's not doing well. Companies aren't spending, companies aren't investing. That's what you hear, right? Now the red line is new economy spending, information processing equipment, intellectual property products. is a straight line up from with a small dip in 2008 all the way up. It kind of tells you there are two economies. There's the old world cyclical economy, and there's this new world straight line up economy. In the year 2000, when everyone was so exuberant that there was endless growth and no risk, the idea was correct. The problem was the new economy was too small to make a difference. In 2002, it was only 25% of the total, and by 1999, it was even much smaller than that. Today, it's 54% of the entire spending. It is totally different. It helps explain why the indices are being dominated by, you know, Amazon, Google, Facebook, etc. It's hard to see why that's going to change. We look at revenue growth. Tech revenue growth is up. And this is just indexed to 100. S&P X Tech, it's up, but not as much. Margins, you're getting great margin expansion in technology. You're not getting that in the S&P. So, you know, this may seem obvious, but in a low growth environment, as an investor, you want growth, buy growth. Okay, by the way, I made a switch. You know, I looked at the LEI and I said, that's a reason for us to be worried. Risk of recession seems to be rising. Then I jumped to, you know, kind of where do you invest or something else going on. And one of the things I'm pointing out with this technology stuff is the economy may be getting less cyclical. By the way, just from manufacturing versus services, manufacturing today is only 11% of GDP. When you know, that just seems absurdly low, but it's really a very small piece. Cyclical sectors have been breaking out. That's usually a sign of an economy that's not about to go in recession. That would be the opposite of that, so that's positive. European stocks, after going through a long period of time, you know, they saw a high in 2007. They finally are breaking out to new highs today. And, you know, who knows why, but one issue is there is quantitative easing in Europe. Interest rates are negative. There is a lot of monetary push to make Europe do better. But it's hard to believe that if Europe is breaking out to new highs, that the U.S. is going into recession. Okay, I think this is one of the more interesting charts. I mentioned that, you know, I would say if you look at almost every, you know, the most frequent commentary you see on the market is overbought, overvalued. Long duration cycle, it's got to end, right? Okay. Now, on the far right side of this chart, it shows December 1999. So in December 1999, the actual PE, forward 12-month PE of the S&P 500 was 25 times. If we look at the BAA bond yield, it was 8.2. Yield is yield over price. PE is price over yield. So if I invert the bond yield, I put 1 over 8.2, it gives me an implied PE for the market of 12.2. It was saying the bond market thought that things ought to be trading in the equity market at 12.2 times, not 25. The bond market was saying stocks were wildly overvalued. In 2007, the same thing. Actual PE of the market was close to 20, 19.9. Implied PE from the bond market, taking the 6.6 BAA bond yield, converting it, was 15.3. Today, we have an elevated actual PE, 18.2. But if we invert the bond yield, it says the market should be trading at basically 26 times. If rates stay low for a long time, and that's what we're seeing with inflation, Fed funds rate projections, etc., it's not hard, it's conceivable that the PE of the market will expand further. And if it were to get to 26 times, it would be a lot higher. Here's just an example. What did I do here? Oh, I said basically, if we assume it did what it was supposed to do using this bond yield, we'd be at 4,200 on the S&P 500. Okay, this is just a long-term look at the stock market and how it goes up. This is essentially, 1945 through 2020, and basically you have long bullish periods marked in green, and then you have these multi-year bearish periods, 1965 to 1982, 17 years of bearish, 2000 to 2013 bearish. In the bearish periods, you have those significant drawdowns and no real appreciation. And then in the bullish periods, you get the nice up. I have a quick question.
It has to do with your bond yields. Those are corporate bonds, I take it?
Yeah, corporate bonds with a rating of BAA, which people use.
BAA corporate bonds. Thank you.
Okay, so let's say this was the only chart in the presentation, and I looked at it, and somebody said, okay, quick pop quiz, are we bullish or bearish? I go, I guess we're bullish, right? We're in an up move right now, and so one is we're bullish, and two, these bullish periods tend to last a long time. Here's a chart basically showing it. So there are two ways to look at it. From the bottom up, or from the point where you reach break even. That's the point where you got back to the old high, and then from there, how long did it last? And this chart shows, in the period going from 1933 to 1965. After you reach break even in 1954, you still had another 11 years of up. 82 to 2000, you had 18 years of up after break even in 82. We've only had from 2013, 6-7 years of up. That's a relative. That would be a curtailed bullish period relative to history. And then this is a similar chart just showing how losses are concentrated. And we use this chart a lot just to give people a reference. But in the worst two non-recessionary years, calendar year basis in the S&P, were 1966 and 1957. And in both cases, the market was down about 11%. That's just a good benchmark to have, because let's say you're a subscriber to the Delta Market Sentiment Indicator, the newsletter, and you see we're saying there's no recession, and you see the Delta Market Sentiment Indicator is low, like 10 or something, and the market's down 14% or 20%, and in a non-recessionary period, the two worst calendar years returns were minus 11, the risk reward of buying is pretty good. It would be an historic event if you didn't at least break even. Okay, so I'm just going to throw one other comment in. I think, like, if I was trying to find a historical analogy for where we are today, it feels a little bit like 1998. And what I mean by that is the Fed in 1998 got worried about long-term capital failing. There was a little issue with Asia overcapacity and issues in the semiconductor market. And so they actually cut the interest rate. And they took the Fed funds rate down, and then we had a tremendous bubble. The NASDAQ went from 2,000 to 5,000. Assets just ripped up. People got very exuberant. It kind of feels a little bit like that. I agree. I think it was good that the Fed cut the Fed funds rate. It was too high. The longer duration rates were telling us it was too high. But it does open the door for asset prices to rise materially. Like I'm showing, if you invert the bond yield, it puts a much bigger PE on the market. And so if we start to move towards that 25, 26 PE, it's going to be very, very extended, and risk is going to be quite elevated. The point of that is to say, I think it's very reasonable that we go to 35, 3,600 on the S&P this year. It's possible we do better because of the possibility of an asset bubble. But it's, something to be aware of is that one of the things we haven't seen in the last 10 years is, I'd say, excessive investment in anything. Other than you could say bonds. One primary reason why the world falls apart financially is the cost of capital goes to zero. So let's just take the home loan situation. Loan to value went to zero, or you could get more debt than there was equity value in the house. Anybody could borrow. And then on top of all the free money in the direct lending market, we wrote credit default swaps, and we put on $55 trillion of derivative debt, and it got totally out of whack. In 2000, anybody who had a company that had some kind of technology idea, it didn't have to have any operating experience, didn't have to have any returns, no financials. They could go public. The market would accept and buy anything and everything. So essentially, it was free money being thrown at something. And when you have no cost of capital, eventually the money eliminates all return. We haven't had that problem so far, but we could in the next 24 months if things go that way, if it's like 1998. That's it. Question in the back? Yeah.
As you dissect the LAI and its 10 components in the mixed picture we have now, can you see anything that directly is attributed to the trade war?
Yeah, so the big thing is the trade war has caused a manufacturing recession. That sounds like strong words, but world trade flows are smaller recently than they have been in the past. There's just less trading globally than there's been before, and that's most likely caused by tariffs and uncertainty around tariffs. The United States manufacturing PMI, which is a measure of manufacturing activity, has, I think, either been 6 months or 5 months consecutively down, and it keeps getting to a new low. So it's in contraction, and it's getting worse. So manufacturing is a problem. Now, here's the next thing. So the LEI looks at a lot of things pertaining to manufacturing, like new orders, employment, things like that. So that's the manufacturing component of the LEI. The question is the manufacturing component of the LEI too much in a world where only 11% of the economy is being driven by manufacturing? That's a very hard question to answer. The LEI also has things like how easy is it to borrow money, what's going on in the stock market, new orders across a range of industries, employment. So, but one sort of question is, because 11% of the economy is contracting, and that's highly represented in the LEI, is the LEI giving us a bad signal? I don't know. I mean, if it is giving us a bad signal, it would be the first time it was a bad signal. So, but it's worth noting and it's worth watching and all. There are signs today that manufacturing is coming around. If the trade war was the problem and we correct the trade war, then the problem should alleviate. So that we'll now see if that's the case or not.
So the portion,
Oh, sorry, man with the mic. Man with the mic first.
so the portion of investment spending in tech is increasing compared to non-tech. How much of that is coming from an increase in the multiple of tech versus their earnings?
So I guess that's an interesting question. You know, like Apple's the most astounding case of this, right? Apple's no real earnings growth essentially, and just stock just doubled in the last year. That's pure multiple. But at the end of the day, it's not really what's driving it. What's driving it is tremendous cash flow. So these companies have a ton of money and they have to do something with it. And what they're doing with it, a large part, is acquiring companies every week. So there's a lot of, so, you know, it used to be in 2000, 1999, 1998, companies would go public. I was at Montgomery Securities and we were taking companies public almost every single business day of the year. Today, all that innovation's not really entering the market because if something's good's coming, the large technology companies that have tremendous, they're almost like investment banks inside of the companies, just pick off the good stuff and only become stronger and better. Well, that raises a question, what should the multiple be for a company that's got that capability, size, defensibility, et cetera, monopoly? It probably should be a lot higher than what the multiple was, you know, 15 years ago or whatever. So an increased multiple on the market is not a bad idea. If you look at the number of securities in the market in 2000, it was roughly 8,000 or 9,000. Today it's around 5,000. Companies are just a lot bigger. So again, that argues for higher quality companies, more profitable companies, more defensible companies, higher PE.
That's not a particularly strong basis to support that 2/3 of the economy on the one hand. The other part of the two economies is the massive concentration of wealth that has taken place in a very small percentage of the economy. Now these people with all this huge amounts of money, what are they going to do with it? They're going to invest it in things like stocks and bonds. A very large percentage of our stocks and bonds are held by a relatively small percentage people. So I'm kind of wondering two things. Is our current stock market really sort of got bubble characteristics that are hidden by this remaking of the economy on one hand? And two, what do we do if we get into another recession where interest rates have been abysmally low? You know, in the past, the Fed used to engineer recessions by raising or lower the rate. Now these days, that seems to be a tool that doesn't work. With quantitative easing and stuff like that all over the world, we've created more debt probably in the history of the financial markets, which go from the student in college up to national banks. So my second question is, what options might the Fed had if some of these possibilities of a recession happen, and under these circumstances, we get in another recession?
Okay. Okay. Those are big questions. I'll see if I can address some of it. So one is, are we seeing, bubbles? The wealth is being concentrated among individuals. It's being concentrated among stocks, in a very few number of stocks, which is always bad, right? You want breadth in a market to make it a healthy market. Again, Apple's a perfect example. Apple was trading at a reasonable mid-teens multiple a year ago, and today it's trading at a high, double digit, 20-something times, 26 times, I think, earnings, something like that, and with very low earnings growth. So just in a 12-month period, a lot of stocks went from being, I think, quite attractive to now you'd say fully valued. And if you were out being a fundamental stock buyer, it's harder today to find things that look like they would have a great return over time. no question. Is the, so that sounds a little bit like the beginnings of a bubble. Can the bubble extend? Absolutely, right? These things all go way further than anybody thinks. So I don't think we're bubble correcting. We're in a baby bubble, maybe a little bubble. The bubble can inflate a lot. Bubbles are good, right? If you're aware, say, oh, bubble, good. I can make money in a bubble. I can ride this bubble until it's not a good idea to ride it anymore. How will I know it's not a good idea to ride it anymore? Well, your risk premium will disappear, right? You will not be being paid to take on any additional risk. So once you see that, bad, signs of recession will come. This recession will rapidly deflate the bubble, if there is one. So people say, okay, over the next 10 years, the stock market should have an average annual return of about 4% because just growth is less. That's probably true. But that doesn't mean you're going to get average annual return. I mean, a return every year of 4%. You might get 30% and then negative 20 and then 15% and 10%. So my view is until I'm presented with a lot of information that says I really shouldn't own stocks, I kind of want to be there. Let's go back 10 years. 10 years ago, we had quantitative easing and everyone thought the dollar was going to be worthless and you should buy gold, and we were in a slow growth economy, the new normal and the new normal, and there was nothing. Okay, well, this S&P has returned 14% average annual return. The dollar is fine. All good, right, through today, let's just say. Meaning the world is a complex place, and things that seem relatively obvious, like we just are going to print it because lots of money should hurt the value of the dollar. It didn't. And the reason why is the velocity of money contracted enormously. People held on to money. All that liquidity that was infused in the economy sat in banks. So it didn't have much effect. So, so that's one thing is concentration. Let's just go back to the points. Concentration of wealth with individuals and in stocks may not be great from a societal standpoint. Currently, though, we want to ride the winners. Let's get involved with those growth stocks. 2, hard to predict things in the world. It's complicated. The questions get too big, like, what are we going to do about all this debt? How are we going to handle the next? I don't know. Not the first issue on my list, because right now I'm more worried about how am I going to enjoy the potential of a bubble. And then I'll worry about the next thing when that may sound crazy, but these things go on for years, right? Like we could have a bull market that goes another 2, 5, 10 years. Thirdly, I'll just give you these 2 ideas. I am saying to myself, if the average return of the market is only 4% over the next 10 years, how do I do better? I like the master limited partnerships, MMP and EPD, because they give you about a 6.5% yield tax-free until you get all your principal back. Done. And they're trading at 13 times earnings. And everybody hates them. Question back.
The mic needs to be on, please.
Okay, so in this slide, I was just showing that technology, industrials, financials, and materials were moving higher. Often before a recession or a downturn in the economy, those don't move higher, they move lower. Cyclicals tend to go down with the cycle, but they're moving up, which is encouraging for the economy.
So we have 2 questioners from online. So the first one is, and you'll be patient with me while I go manipulate my thing here, and that is, you mentioned the importance of growth, and the question is, what do you think about dividends? And they mean seeking growth stocks.
Well, let's jump from dividends to corporate stock buybacks. One might ask, how does the market go up when everyone's pulling their money out of it? The basic answer is corporations are buying the stock back. Dividends, I do think it's interesting to watch dividends. I mean, particularly right now in the energy sector. The energy sector is very, very depressed. You can get 5% yield out of Exxon Again, I mentioned the master limited partnerships. If you're a dividend investor, there, but investing for dividends and yield is a totally different game than buying growth. And in some sense, the question I'm answering more is, let's say you've been involved in the market at some level. Are we selling our stocks today or not? My answer is not yet. Are we? Where are we positioning? Are we going to sell those big winners that the growth stocks and move to value? No, just stay with your growth stocks. Stay there. Are we moving from large cap to small cap? No. And the reason for that is that small cap tends to move more radically in a downturn, so it's a less defensive place to be. So those are some of the, and we think this year should be a decent year, unless, and this is why you have to get the newsletter, because we look at this every week, and we could revise our opinion, quickly that, hey, this looks more like a recession than anything else.
Okay, the second individual has two questions. One, given the outlook that was provided, that is low rates, no recession, risk flagged as of now, what sectors would you be overweighting? Tech, I think is what you said. Again, given the market outlook, any commentary on gold and gold stocks? So there's two fronts.
Yeah, so shockingly, I'll just jump to the gold thing. Gold has actually, over the last 20 years, been a pretty good investment. The problem is you had to invest in the first 10 years, not the second 10. But if you average them together, it was okay. Gold is one of the few assets that's still below where it was in 1982. Gold is not gold is a commodity. Commodities generally go up and down based on, oversupply, demand, whatever. It's demand, supply driven. They don't have earnings. They don't have dividends. I don't think gold is a reserve currency. I don't like buying gold. We don't buy gold. I don't think it will protect you from anything necessarily. I think, if you're looking for that defensive position, buy U.S. Treasuries and then pick your duration. The other question is what sectors. So again, as a stock picker, we often buy indexes, major market indexes. We own things like the Qs, the S&P 500 growth piece, which they have S&P 500 value, S&P 500, and S&P 500 growth. We own the growth side, but we are, and there's, I don't have a lot of great ideas, but two things I like are these master limited partnerships. I also like high yield municipal debt that doesn't have Puerto Rican exposure, because you can get about 4.5% federal tax-free in high yield muni debt. So if you're feeling a little uncertain, you don't want to play the game of let's see if we can run with the market until the very last minute, whatever else, high yield muni debt, corporate debt feels very bubbled. But high yield muni, and there are funds you can buy. There's a Pioneer fund, HIMYX, that's the institutional share class. And it's a 4.25% yield paid monthly, federal tax-free, and about 30% of the bonds are state tax-free for California. Oh, okay, Mike.
Are your recession predictions influenced by inverted yield curves?
Absolutely. So the two factors are the LEI, Leading Economic Index, 6-month moving average, and the 2-year, 10-year Treasury yield curve. That inverted for 3 days in August. That's it. The 3-month, 10-year inverted for 6 months or so. It was quite inverted. But that was more a function of the fact the Fed funds rate was distortedly high. Right now, the yield curve has an upward slope. It's fine. It is a little bit concerning that it did invert for 3 days, but you could say, let's just say that's a blip for now and move right along. But yeah, we do look at the yield curve.
I was just curious if you'd speculate a little. on that last couple of weeks that you said didn't do what you thought it would, given all of the upheaval? Usually when there's a lot of political upheaval and, you know, we're bombing people and others are bombing us, there's kind of a downturn in the market, and yet this one went zip. I don't know. Would you speculate on that? Couple of weeks?
So let's just take the last piece of last year. We had sort of a melt up. And I would say that institutions were under-invested in equities and were generally underperforming the indexes and had to get invested. So that to me was just money, you know, funds follow performance. It was just fund flows chasing performance. A little bit of that kicked into the first week of January. I just have to say it is a surprise that the knee-jerk reaction to the situation in Iran and Iraq wasn't more of a downturn. You take Brexit, we lost 5.5% in 2 days and then immediately recovered. I mean, most of these things when you get this kind of news are a quick knee-jerk down. I don't know how, I mean, so what we did this last newsletter, we just looked at the last 4 times the U.S. has gone into the Middle East and initiated hostile action in some way. And in 3 out of the 4 cases, the market was up 10 to 25% over the next 12 months. But it may just be a signal that whatever's going on in the Middle East has become less relevant. I mean, I think the other thing going on, obviously, is that the United States has achieved oil independence. So it used to be we were worried about if we were attacking Iraq and Iran, that oil flows would slow and gas would. I mean, the truth is, if we do disturb the Middle East, on the margin, there will be less flow. But the idea is that Saudi Arabia has enough oil capacity to make up whatever stops coming out of Iran or any impairment coming out of Iraq. So we don't, there's no, and if you look at oil prices, they haven't really moved much. So we may be getting to a time when just a step function change where because we're not dependent on Middle Eastern oil, the whole region is just less important.
If you were convinced that we were on the brink of a recession, what sort of portfolio modifications would you anticipate making? And did you do that in the last recession?
Yeah, so in 2008, our sort of benchmark, our premier strategy, our strategy was down 1.5% in 2008, and the S&P was down 37. And the way we did that is we went to cash. You know, actively, you know, IRA money, tax protected money, if I thought we were going to a recession, I would move to being very, very, very defensive. Like you can buy ultra short duration bond funds that have no principal volatility. They're yielding about 2%. So I would look at things like that. I would just go to preservation of capital. In a taxed portfolio, where I can, you know, obviously I'd be culling tax losses, but I would be, you know, any new money or whatever, I'd be migrating into sort of non-correlated equity investment, like high yield muni debt has a 0.06 correlation with the S&P 500. So that seems okay. You know, again, high yield anything, there is a chance it blows up. These, you know, again, on these master limited partnerships, I look at that as, okay, you ride that through 10 years, the dividends will increase steadily through time. And you know, there's potential for 5 or 6% principal growth through the years. So if I say I have a 10-year horizon, well, that carries me through the next recession and on to the other side. And I'm buying them at 11 and 12 and 13 PEs today. So I'm okay riding that. But I would certainly look where I can to reduce exposure.
So Nick, one of the areas you had mentioned treasuries as defensive. What would be your alternative to treasuries if rates were to go up and then treasuries were to take a hit?
Okay, so normally in a recession, the corrective response is to cut interest rates. And so normally in a time of, you have two factors going on. In a time of crisis and in a time when the economy is slowing, you have what they call a rush to safety, so lots of buying of Treasury, and then you have this cutting of interest rates. If you had bought 30-year Treasuries in 2008, you would have been up 30%. And there were funds that were, levered 1.25 times or whatever. You could lever U.S. Treasury and really have killed it. But after Treasury, cash is not a bad place. And I know it sounds like, okay, I get nothing, but nothing is not bad. Having a big cash portfolio in a down market's good because the day it feels like it's time to buy, you can do it. You actually have the liquidity. You're not locked up in anything. You don't have to sell something. You can act immediately. So I don't mind sitting in cash in major times of crisis. The only two things that went up in the last several times were Treasuries and cash. Now, there are inverse funds. There are mutual funds. There's one called Grizzly, I think, or something like that, Grizzly Bear, that will go up in a bearish equity market. It's just hard to play that because when you're playing the downside, you're fighting time. Not only do you have to get the direction right, but you have to get your timing right, and that's hard to do.
Question from online. Are K1 forms from MLPs difficult to enter? And this individual found them difficult to work with. So
So yeah, the MLPs, EPD and MMP are the two ones I'm talking about. They are K1 tax reports. Now, here's the problem with MLPs, these two MLPs. Because they're K1 tax, they can't be included in an ETF. So they're not part of any sort of just ongoing automatic buying from ETFs and things like that. Enterprise Products, EPD, is highly likely to convert to a C-class corporation probably this year. If they do that, all of a sudden, all the ETFs and whatever else have to buy it. If they were to do that, if it might cause as much as a 25% upside move in the security in a very short period of time. And while you wait, you get paid 6%.
Question. After 2008, 2009, assuming you went to cash, when did you re-enter and what prompted you?
So again, we have a lot of different strategies. We have some strategies that are based on macroeconomic, the LEI and the yield curve, and we have some that are based on the Delta Market Sentiment Indicator, and we have some that use kind of all of it. So let's just start with that strategy I talked about that was down 1.5% in 2008. So during the course of 2008 through June, it was up 11%. It went to cash, and in November of 2008, it re-entered the market because one of the rules of the strategy is when the Delta Market Sentiment Indicator is below 10, it has the right to buy because the market's so oversold. The indicator only goes from 0 to 100, so if you're below 10, you're pretty far down. The market kind of did okay in December, and then we lost another 25% market value through the first quarter of 2009. The reason why the stock was down 1.5% is because it re-entered the market in November. That was not good. It then got out, and in 2009, it re-entered April or May, pretty close to the bottom. Now, okay, so just for your own trading, every single time the Delta Market Sentiment Indicator has gone below 10, it's been a good time to buy. If you'd bought in November of 2008, you would have seen further loss in your portfolio, but over a 12-month period, you'd been up nicely. You'd have bought the S&P at around 1,100 or less, 1,000. It went to 666. Okay, so that was that indicator. The LEI, surprisingly, the leading economic index will turn positive on a 6-month moving average, typically within 2 or 3 months of the bottom. So it's pretty fast acting. It's not exactly the bottom, but it is the bottom. You know, it's close. So I'll just give you a more recent example. In 2018, the strategies that were tied to the Delta Market Sentiment Indicator went out of the market on October 12th. They missed the decline of the fourth quarter. On December 27th, Delta was one of the largest buyers of the S&P 500 in the United States. It was kind of a quiet time between Christmas and New Year's, but we had a bunch of things going on. We had no degradation of the LEI and the yield curve at that time, so we had no recession indicator. The Delta Market Sentiment Indicator dropped below 10, and so that was a signal to go all in. So we went all in. It worked out. We're up 30. Now, the performance that we achieved in the next 12 months was exactly typical of every other time this has happened. It was not unusual. It was nothing different. It was the same 30% that you should expect when these things happen. Mike,
I share your enthusiasm for master limited partnerships. Help me out here and tell me what I'm missing. The guy who asked about the K1, I have never completely understood all the accounting I give you, but I know I have to keep the K1 and the losses and the profits because it's a return of capital. And therefore, should I sell it, I have to subtract the return of capital from the price I sell it at and then pay my capital gains. Am I missing something there?
No. So over time, the tax man will catch up to you. That is true. Yeah.
Nick, thank you for your presentation this morning. Very helpful. I have two unrelated questions. I'll make them quick. One is, could you share with us just directionally how you're positioning your clients in terms of cash today? And then secondly, totally unrelated, when you think about valuing a company or the market, do you think about valuing earnings growth driven by share buyback differently than typical earnings growth? Like, you know, many of these companies are driving 50% of their EPS growth through share buyback. Thank you.
Yeah, no, that's a good question. So today, essentially, we're, you know, as close to 100% long as you can be equity. We're in. Again, we have the ability to change that rapidly, but we've been in and we're still in. And, you know, looking for the thing that would make us go out, but there's nothing yet. On the, you know, I call the second part of your question a quality of earnings standpoint. What I've noticed over time is the printed numbers matter and the rest doesn't. In other words, it's odd. Like you would think that companies produce earnings through, you know, revenue growth and, you know, margin and, you know, expansion or, you know, quality investment, new opportunities or whatever it may be ought to be more highly valued than people that financially engineer it. But it turns out the market seems to reward everybody the same for whatever the printed number is.